Welcome to the Broken Pie Chart Podcast, episode 311. I'm your host, Derek Moore, and guess what? Guess who's back?
Guess who's back? Back again. I'm glad to be back, Derek.
Yes. Yeah, no, the internets and the audience has been commenting. They don't like it when you leave. So
I didn't like not being here. I'm glad to be back.
I did relegate you back to the semi-permanent co-host from co-host, but
listen, that's okay. I feel like I've given up the co-host mantle fairly quickly. So my apologies, but I'm glad to be back. We got a ton to talk about today.
Well, no, not really. Just tariffs and interest rates and the Fed. And all right, let's start with tariffs. I'm going to give a contrarian take on this. And we saw there was a great chart. Okay, I don't even know who put this out, but somebody put it out on Twitter. If you're listening, you did a great job. And it was the tariffs and trade wars, but it was a map of the S&P 500. And 2017, you have U.S. withdrawals from TPP, the Trans-Pacific Partnership, U.S. renegotiating NAFTA, markets go up, U.S.-China discussing tariffs, market go down, then they went up. U.S. tariffs on washing machines and solar panels. Keeps going up. China announces new tariffs. Keeps going up. Makes the new high. And finally, what do we have here? The market sells off, but really that was Volpocalypse. And let me see. That was how a trade war with China could hurt the tech industry. And then at the bottom, before it went up another 8% higher in the next couple of months, trade war escalates. China says it will impose tariffs on 128. You look at this chart, and I can't really point to anything on this chart that says this is why the market did what it did.
Yeah, I mean, this is whoever pointed these dates out. And I don't know if it's a comprehensive dates of all the things that are happening, but these are some pretty major events. We're going to talk about, NAFTA, the first round of tariffs. And I remember when that happened, right? It was like, whoa, market seemed to get volatile. But, when you map that on the S&P chart, there are positive returns after every one of these every one of these announcements. So it's I feels like the point that whoever posted this was trying to tell us that look, when you get this news, it doesn't necessarily mean the market's going to go down. Actually, historically, last time it went up. I don't know if that means this time it'll go up every time we have bad news. But we saw how the market reacted 2 weeks ago, right, when the very first tariff was proposed, and then everything was walked back a little bit, but the market reacted positively. But this is, I don't know if history is going to repeat itself, but quite frankly, this is an interesting chart, and against the timing of when these events occurred, it looks like historically it's been positive. And I don't know if that's why the market went up, but it wasn't the thing that caused the market to go down. That's for sure.
Well, I think you and I agree too. Tariffs aren't necessarily inflationary. At least they weren't in 2017, 2018. I mean, they weren't. Let's just be honest.
No, they were not.
No.
Has anybody been pointed to look, everybody says this is a tax on people, on Americans. Americans are going to pay the price of a trade war. But has anybody gone back and, analyzed, Eric, why that wasn't the case? Was it because the economy was so strong and supply was strong enough that you didn't have inflation and it didn't matter? Was there a transition of the goods bought from China to America? It'd be interesting to see that.
It would. I don't have that data, and maybe I should have. I pointed out last week on the show you missed. I'm sure you've listened to it in your car on repeat multiple times.
On the plane. I listened to it on the plane.
No, there you go. And you heard me talk about, the dollar going up by a lot of money, or by a lot of percentage points, or a lot, can mute some of this stuff because things that we import. I was waiting for you to talk about the impact on NHL teams in Canada. I know you're waiting for that discussion, but
do they have hockey in Canada?
Oh boy. So anyway, Canada's dollar falls, US dollar goes up. Canadian teams, remember, they're making Canadian dollars. and you're competing with teams in the US who are paying, sort of the players' salaries. I mean, there's caps across the teams. But all right, let me not get into hockey. It's just there's currency fluctuations, and those can mute some of the items there. I don't know. I mean, I always go back to there's always a reason to worry about the markets going down. And by the way, that's why we buy and hedge. It's one of the core things we do. But we'll talk about a chart later. You look at events. If I were to tell somebody we've had World War I, World War II, Korean War, Vietnam, the Cold War, oil shocks, we've had interest rates go to 15, 16, 20%. We've had recessions. We've had Fed doing different stuff. And the market just made an all-time high not too recently ago. Like stuff that people think is important, and it is. But there's always a reason to worry. And over time, historically, markets have gone higher. They've gone lower for periods, but that's why we hedge, Jay.
That's why we hedge. And I'll tell you, it's, you're going to have the ups and downs. There is certainly a lot of the tactical maneuvers and news-driven cycles. I think does the news feel faster now? It always feels like...
You've mentioned fragility. I named one of the episodes when you're gone, fragility. And I think that you're right. The news is faster and things are fragile, wouldn't you say?
Yeah, no, definitely fragile, right? Like, so we're recording this on Friday, the 7th. And it was the day that, we got the jobs report, and it was fine. And maybe it could have been interpreted as a little inflationary, but the market kind of blew it off. But as soon as there was tariff news, right, the market started dipping a little bit, and then it was walked back. And it seems like we're really reactionary, headline reactionary. And by the way, I'm not saying anything that's, that's new here, but headline reactionary, and then you let stuff settle out. If you were a seller on that day, on Monday, when kind of the tariffs were first proposed, or at least mentioned, you found yourself on the wrong side of the market because it went up that day and then proceeded to go up the next 1, 2, 3 days after that, right? And so, look, I mean, if you drew the same chart today that we're looking at, right, including this past week, you would show appreciation after the first tariff announcement of the market. So it's don't let the headlines redirect you in the wrong way. It's not necessarily, historically speaking, what we've seen, it's not necessarily inflationary, and don't get whipsawed by the headlines. I think, look, we're all guilty of getting whipsawed in the markets with your tactical money. I'd say if it's money that you're trying to pick a direction, which again, for us is a very small portion of the portfolios we manage. But it's just one of those things that, everybody can get whipsawed, and you're going to be wrong a fair amount of time. Sometimes it's just, life can be easier to buy and hedge. It really can.
Let's talk about employment. Since you brought that up, it's a good transition point. And I will tell you that, so the BLS puts out an employment report. They release a PDF, and it has a lot of data. Normally, there's a final column, and in this case, says the change from December 24th of 2024 through January 2025. So the January is really the December number. But anyway, it's when the report comes out. And I don't know if Doge laid those people off, but there's a bunch of just dots when there should be numbers.
The data is not complete. I guess somebody felt like you could do the math yourself. I mean, the data's there, just the subtraction isn't there. I can't believe somebody was actually doing the subtraction, Derek. It feels like somebody just didn't format the spreadsheet properly.
I don't know, but what I do know is unemployment.
But if there was somebody whose job was to subtract two numbers and then put it in this report, they probably should go.
Okay. Oh, all right. I don't know how much we'll save, but yeah, well, 4%. So maybe we'll see that reflected next month, but 4% is the unemployment rate.
There you go.
Last month, it was 4.1. In truth be told, it was like 4.08, I think. They round up. And this one was like 4.02 or something like that, if I did the math. So what do we see in the employment? We saw the rate come down. Labor participation went up. The civilian labor force went up. The number of employed persons went up. The number of unemployed persons went down. So, and I think wages were hotter than expected as well. So,
yeah,
it's kind of mixed.
Yeah. I thought it was fair. There was, I think there were strong revisions to the previous month as well,
Yes.
right? And so, I don't know. When I look at that, and then I looked at kind of the wage growth, you'd think that's good for spending, but not great for inflation, right? Or companies have to pay more, so eventually they charge more, right? That's why wage inflation is a little scary. By the way, it's also super sticky, right? It's hard to people start earning a certain rate. That's what they plan to earn going forward, right?
Well,
People
barring a recession, that's how it becomes unsticky. But
yes, yes,
agreed.
barring a recession, you got it. So like those, so I thought those were fairly like those between the stronger, the good job report, the revisions from the previous month, and the higher wages. I thought it would be like, well, probably less urgency for the Fed to cut. Like they probably, the bond market probably reacts with higher rates. And I think, Dirk, when we looked immediately right after, the number of projected rate cuts dropped. Now, you and I know it's okay if the Fed doesn't cut rates, but there's been a high correlation between, the expectation of the Fed cutting and the movement of the equity markets, meaning the more cuts, the market has been more constructive.
Do you think they're done though?
No.
I think they're done.
Okay. I don't think they're done. I think they got one in them.
All right. So what? That's a gentleman's wager then. So I'll say there are no more cuts.
And I'll take one.
Yeah, we have some open ones too. I forget. Oh, we said did I say 7,000? Or no, we both said 7,000 by the end of the year.
We did.
We will touch. I forget. I'd have to.
And by the way, we have our projections on interest rates, right? We don't have to make a separate wager here. We've already projected that in our.
Oh yeah, we did. Can I? But I think I want to change mine.
Oh, all right.
I want to make an adjustment.
Get a mulligan, first month mulligan.
Well, I mean, we've lowered 100 basis points in 95. It was 75 basis points total. So, but back on track. I think your point is it showed a little bit hotter. Unemployment is going in the right direction, meaning it's positive, it's coming down. And that would lead you to believe that there's the Fed rate cuts that are priced in are not going to happen. And that would have been bearish. But I think, you've already said it, the market took this really well until the tariff stuff.
Yep. So, I think we'll see what happens again over the weekend. Last time it was a weekend thing. I'm trying to remember, there was a cycle where you just didn't want to be long into the weekend, right? It's happened before where you'll go through and every Friday, it was around the banking, the 23, I'm talking recently, the 23 kind of banking concerns. You remember every Friday there was a little sell-off or there was a pop in volatility because people were buying puts going into the close because they didn't know which bank was going to go under over the weekend, right? So I think we probably got a little bit of that dynamic going on here. Like, what do I know? That's a weird prediction to say. Fridays will be down for the next few months, but
hang on,
I'm writing
that down. Yep, Fridays will be down. Got it.
That's what he said. I won't come back until I'm right. So I think that's kind of the mentality right now. The market is definitely susceptible to that headline risk. What the reality is who knows? But this is the theater that we're managing within today.
All right, on payrolls, so non-farm payrolls. So when you see the employment rate or the unemployment rate, that's from surveys. And then you have payrolls, which is the household the business surveys. That's where they survey businesses and they get how many workers and stuff. And then, of course, that gets revised to the state numbers, the actual state numbers later on. That's why you see the revisions, and what you see now is the survey stuff. But would it surprise you, Jay, if I said from February 1939 through January 2025, so that's like the one that just came out, this period that we're in right now is the second longest consecutive positive months in non-farm payroll growth.
Yeah, I mean, we've talked about this in the past, like, hey, if we kind of hit the number, a few months ago we talked about it, like we're pressing up again. So I think that's great. I mean, the market has been, fairly strong since 2022. This would mean, though, this is like 4+ years, right?
Yeah, I mean, to give some context, it's from 21, right? So 49.
21.
Yeah, 20. It might be 20. The scale is, this is from Charlie Bolello.
Well, I think we know how to, there's 49 months and 48 is 4 years. So it's probably.
Oh, yeah, you could have done it that way too.
Probably
Fine, you do your little
January of
math.
21, right? Do I have that right? I don't know.
Trying to get all fancy on me with math. All right, and then the previous one was 113 months. So that's 9.42 years. So that one was coming out of, '09. And it looks like August '09 maybe up until, but yeah, I mean the previous high was back in the late '80s into '90 as 48. So I don't think either of us saying, well, that means we're at a top here, and it's typically doesn't do this, but okay, this is kind of interesting that we're sort of at the higher end of the range, but for the the long period coming out of the great financial crisis.
Yeah,
anything here? I don't know.
It is the highest of the range if you take out the financial crisis.
That's right.
Rebound. So, I mean, and the report was still strong. Didn't we have one report that was just like plus 12,000, right? Recently?
Yeah, but it kept the streak.
The streak, right? It just squeezed by, right? And then when I look at this historical data, I'm looking at your 94, 95 range. It wasn't even close to the strong, right? Mm-hmm. You had periods where you had job losses. So I think, short of the R word, recession, this trend has no reason to stop.
Okay. One more thing on employment.
I guess unless AI replaces all of our jobs next month, but besides that.
Well, maybe so. We'll talk about AI in a little bit, but let's think about one other aspect of unemployment. So we've talked about how in the BLS, I read through the report, and one of the things they always say is when they're doing these surveys, they don't make a determination about whether someone has just come to the country or whether, any of that. But I do wonder if there's less immigration to the U.S. and less foreign visitors are getting work permits. Does that mean that the unemployment rate will go down because the labor supply will go down? It's one of those things. I'm just thinking ahead, like in the next, 6 months or year, if that's something. And I suppose, it's supply and demand.
Well, okay. So if you go that route, it would be inflationary from wages got to go up because you got to pay more for less folks willing to take a lower pay rate. But Derek, I'm gonna throw something out there that I don't know if you had thought about. The world changed after the pandemic, and yes, businesses adjusted because it was hard to get people to come in to work, right? So I don't know about you in Arizona, but here in Florida, like it's still not like you can't go to a mall at 9 a.m. and walk in, right? Like they just don't open the doors, right? It's like, yeah, you got 10 to 6 o'clock and like, that's about it. And it's I think so my point that I'm bringing up here is I think businesses will adjust their model and actually create more efficiencies because they won't be able to fill all of those roles. Now, there's some stuff you can't do like that, right? Construction, like stuff that you physically have to do the work, with your hands for. Mm-hmm. Like, I don't know, the guy that comes and cleans your pool. You can't do that with AI, right? You probably clean your own pool. But
no, I don't. No, I have somebody.
Yeah. So I'm just so there's some stuff that can't change there, but I do think that you'll see a little more evolution in businesses where they're going to go for a more efficient means of being able to deliver the same sales and services. So I'm not sure. Like I'm to me, it's not a guarantee that will happen. I think business will be like, well, I can't fill the roles. So I need other alternatives, and maybe that means changing my model to a more efficient version, and just people are just going to have to understand.
Well, you mentioned AI. Let's transition there. And mentions of AI on earnings calls over time as of February 5th to 2025. This is posted by Isabel Net, source Goldman Sachs Investment Research. Okay. For Q4 2024, 50% of firms mentioning AI during their quarterly earnings calls. I don't know in what form they mentioned. I feel like, and I was on Spencer Wright, Spencer, he guest co-hosted a couple of weeks ago. And we were talking about, is AI really the sixth great technical revolution in the last 200 years? And his thought was, yeah, it was. Like if there's productivity and if there's efficiency that comes from this, and companies really get smart about using this, you're right. It might cause unemployment to go up, but it may cause margins in some of the S&P 500 companies to actually go up as well.
Well, I mean, do you think that's not the underlying theory here?
Well, I do think it's the underlying theory, but I think there's also going to be. We always look at it from the market. There's a saying: the market is not the economy, or the economy is not the market, or one of those two. Use whichever one you like better. I think the stock market could still do well, even if they are getting margins that are expanding, and AI is behind it. I don't know. Maybe not. But companies are mentioning it. Every company is.
I also think there's, and I mean, at this point, if you don't mention it, you look like you're a dope compared to your competitors, right? Oh, that's a dope is a Joe Moglia term. He used to use that all the time. Don't act
former
like
CEO of TD Ameritrade. Yeah,
yeah, and coach of Coastal Carolina for a long time.
Is he still the coach down there?
No, he is still, I think, involved in the athletic department, but he does a ton of stuff. But anyway, right, you look like a dope if all of a sudden you're like, well, you didn't say anything about AI. Well, we're doing it, but we didn't talk about it. Why? Because you're behind your competitors. So I think there's a little bit of, one-upness, showmanship here and using the buzzword. And I've now used it like 4 times, not because I was trying to not look like a dope. It's the buzzword, right? It's the thing that has been propelling this market since June of 23. When NVIDIA first, started blowing earnings out. So maybe it was July of 23. So I don't know. I think we all know this is going to be transformational. I heard somebody compare it to the light bulb, right? Productivity significantly increased when, big inventions occur, like the light bulb. It's like, I guess so, right? I don't know if I would put it on that level of impact, but that's kind of, the way the world is thinking about it. And, I think, it's weird to see so much leverage on one thing. I mean, the DeepSeek sell-off from 2 weeks ago now was like, wait a minute, maybe it's great, but it doesn't have to be so expensive. And our companies are spending too much money. But, and I'm sorry I wasn't on that podcast. I know that we would have had a really good time talking about that.
Oh, yeah.
But look, I think efficiency and margins are absolutely one of the is a driver that corporate earnings are going to need to experience to grow into their PEs, right? I mean, I think that's a lot of the forward-looking pricing that we have.
I have a contrarian take on the DeepSeek thing, and I get it. If CapEx is on spent to NVIDIA and the chip makers is, I think I've seen the comparison of if it's only Professor Aswath Damodaran said, what if it's 300 billion instead of 600 billion in CapEx spending? And that's kind of how the market reacted. But who's to say that they won't want to be the leader? If there's competition for these models, don't you need more and more computing power? Where they are right now is not the end state. It's still not awesome. It's still not completely awesome. It's still not foolproof. So I feel like there's still going to be development to try and get the best models and to go even further. I don't know.
Yeah, because you think about it, is it the hardware or the software? Well, it's both. And I think you're going to have a lot of hardware that is used with software that eventually is the loser here, right? And so I think I think it's both, right? And it's this advancement of the technology, we don't know all the parts that are moving, but right now everybody's kind of betting on all horses, right? I know you've used the picks and shovels example, but I think you could even expand that of how there are going to be winners and losers here. Typically, the winners, the leaders going into a space aren't always the winners coming out of it when it finally establishes itself. So obviously we know why, Google and Apple and Amazon all want to be, pretty important here, but I don't think we've really seen the big winners out of this yet. And eventually the big winner is the end consumer and companies that can take advantage of this. But I think it's early innings here. I don't know. How much has it worked its way into your life so far, Derek?
Oh, a lot. I mean, I use it a lot. I wouldn't say all the time. And but it's,
has it made dinner reservations for you yet? Has it planned your vacation yet? Has it organized your son's class schedule yet to be conducive with your wife's work schedule?
You make fun of me because I know you have an Android phone. I've had an Apple phone for years, although I used to have one. The Siri on Apple, the AI assistant, even with Apple Intelligence, is useless. I'm sorry, Apple. Tim Cook, do better.
Yeah, the Google one's pretty good.
That's what I hear. The Apple one, it's not intelligent at all. Like I asked it one day a question and it brought up a website on something completely different. I'm like, I could have just Googled that, Yep. No, that's where, that's the thing. Like at some point you'll be able to put on all that stuff. Like I could see being able to save like a profile and, here's the sushi place or the place I like to go and here's exactly what I want and just do the whole transaction for me. Like make the call, order it, get me what I need, tell me when it's going to be ready. I don't know. It's all right. Let's move on.
All right. Okay. I will tell you, I used it the other day. I got a long email from somebody and I just had AI summarize it for me and I was done in 5 minutes. It was very helpful.
I thought I thought you used AI to send me that email. That's good to know. All right. Inflation expectations surge following, I'm kidding, Jay, tariff developments. This goes to the idea that everyone is wrong, always. The consensus is wrong. So December 16th, President Trump, press conference reaffirming plans to hike tariffs and the inflation expectations. This is the 7-day moving average from the University of Michigan. Median year ahead inflation expectations. Okay. So it was 2.5% at the end of December, and now it's over 5%. So the consensus now, University of Michigan, they survey people. I've never gotten a call, but apparently they call people up, get them at home. People who have actually landlines and say, a year from now, what do you think inflation is going to be? And if you can see the chart, it's kind of surged right after the January 31st announcement. I would say probably because the media has been telling everybody this is so inflationary, but people can't be right on this.
Okay, got it. That was pretty bold statement there. I think you're right on the the crowd is usually wrong idea here. Right, this has been a pretty big move up. I don't know why folks would think that because last time they didn't experience inflation due to tariffs. So the facts are they didn't. And so now I don't know why they're expecting that it will. You're right. It's probably a little, pushback. I don't know. Who did I talk to the other day? It's actually somebody on our team who was like, tariffs are stupid, he said. And I said, well, look, it's a tool, right? Right now he's negotiating in a public theater. Second time I've used that word today. And, there's a lot to do with public perception. And he's letting, the administration is letting the crowd kind of move things around here. So this is a natural result of, I think, of that. So I do think people are talking about the downside of all of this and stuff's going to cost you. By the way, I have office furniture coming in overseas that was already on the water and now it's coming into port and it's going to get hit with a tariff, right? Like that is, I have definitely will have a direct higher expense because of that. That was unplanned for, right? I mean, it got shipped a few weeks ago and it's coming in and it's going to get hit with a tariff when it lands in Miami. So, not personal, it's business stuff. But the point is, so I think people will see little things like that and they'll blow it up. But I'm with you, Derek. The crowd is, typically not right on things like this.
So what we saw playing out is a little bit of game theory. And a good example of this, I'll take it away from the tariffs. I like to frame things in something else. Do you remember when the NBA did a lockout of their players?
Sure.
Yeah. And for anyone who doesn't know what a lockout is, so players could either call a strike and they're like, no, we're not playing until we get what we want. Owners, when the contract comes up between the collective bargaining agreement and the players union and the owners can do something called a lockout. And the lockout says you are not playing until we get an agreement. And you think about who has the leverage in that situation. Well, the owners sort of have the leverage because number one is they wouldn't be paying the salaries of the players, but the players have a limited window where they're at their prime. And so if you have a professional player who's missing a year in their prime, I mean, think about all those stats that they don't have, or a team that has, a chance to win. And so it's sort of game theory, like who can take the pain the longest. And I think in Trump's case, he made the assessment that some of the other countries would fold before he would because he could take the pain longer. But it's sort of the game theory. And then the Nash equilibrium is like, if you ever watch the movie A Beautiful Mind, they describe it in an interesting situation. But it's like the Nash equilibrium. I'm not going to explain that, Jay. You can Google it. But it's like if you have no regrets, and sort of people walk away from it, and you may not get everything you want, but it's sort of the no regrets play. So there's game theory going on here.
Yeah, I agree. So you get a result like this. And by the way the market reacted to this data was also fairly negative. And who cares? Like, it's an opinion. It's not a real data point. And what's this mean? Like, companies are going to start to change the way they're operating because of this? Maybe. Like I said, I just had a little bit of a higher expense because of that. But it's rare for us to have anything like that occur for our advisory business. But the point is, maybe people plan for it, keep money aside. Like, what do you do what do you do with this information? Like, what does this do for corporate earnings or interest rates? I don't know.
I don't know who's getting these calls, by the way. Like, what I don't. I mean, maybe they're calling people on their cell phone. I'm not sure. I don't know. All right, 2 more things here, Jay. One is somebody put this out. Who put this out? FHFA, created with Data Wrapper. Okay, I don't know who these people are, but I'll look at their chart. Shares of outstanding mortgage loans by mortgage rate. 83% of mortgage holders have an interest rate below 6%. And if you look at the chart and kind of, 2024 is to the right, I mean, the greater than 6% crowd, it's increasing and you would expect that. But the majority of people still have very, very low mortgages relative to what they are today. And the reason I bring this up is I don't pretend to be an expert in the real estate market, but there's still not really a lot of supply coming on. And the reason is like and people got to move, but if you have a low mortgage, like you don't really want to move.
So the point we're talking about here, is you think this is what for, like housing? You think?
I think housing stays up. I don't think it's, barring a recession or a reason for it to crash. And I have no idea. Like, if you want to bet on housing, bet on housing. If you don't want to do it, bet against it. But I feel like there's not a lot of supply and there's not a lot of reason to move. And I'm saying that I think prices will stay pretty firm here.
Okay.
All right, nothing there. All right, let's go to MicroStrategy.
Look, I know you want me to.
You don't have to say anything. Say, I don't care. Let's move on.
No, I care. People care about interest rates. It comes up all the time. So,
all right. I want to talk about MicroStrategy's implied volatility, something you do care about.
I do know that one.
So I'm going to throw the question out. So the implied volatility, let's look at February 14th. So I'm looking at the February 14th, and I'm looking at the implied volatility of, let's say, I don't know, the 100% moneyness. So what is that? 330, right around there? Is it too low? Like I look here, it's a 71 implied volatility, and a 71 implied volatility implies what? It implies 71 divided by 15.875. It's about a 4.47% expected daily move. I bring this up because I think the perception outweighing what the options market is saying the expected move is.
All right. Well, look, it's like MicroStrategy's just had earnings, right? MSTR just had earnings. It was kind of a non-event. Nobody really cared.
But who cares about their earnings? They just hold Bitcoin.
Okay, right. Well, that's what I'm saying. So you have to tie the volatility of MicroStrategy to the volatility of Bitcoin, and we know that they're leveraged. So even Michael Saylor will say we're about twice as volatile. Our stock is twice as volatile as Bitcoin. So when you look at, say, the volatility of, I'll just use a ticker.
IBIT?
Yeah, IBIT is a real easy ticker to talk about. It is the Blackrock ETF that holds that holds Bitcoin. It just holds Bitcoin, right? And when you look at that, it's more than half of MicroStrategy, right? It's more than 40, right? So when you think about this, I think the options market is, I think it feels like MicroStrategy it had its pop. It's been beat up a little bit. This is my interpretation of this because obviously we do watch this fairly often. And its volatility, Derek, is at the lower end of its range. So I actually think if you're saying the markets are undervaluing the implied volatility, I would agree, right? It's only been this low and now I'm looking at, say, the average 30-day volatility, right? So you can chart this. I know you picked the option itself, but if you chart, the implied volatility historically, right? So where it's sitting today here in this, it's about, for the whole, 30-day, it's about 84%, which is a little higher than what you just said. But if you look at that over the last year, it's really only been this low once or twice before. You got a little bit of it back in August of last year when it wasn't doing much at all. And then as it started to go up in October. But, this is one of those things, if you're a volatility trader, you would say this seems like a low level for the volatility of MicroStrategy options just in general. So I don't think you're wrong. I think the options are undervalued.
You made the case that MicroStrategy is a levered Bitcoin play, and we know that story. We won't go into that again. I just did a quick calculation. I said a 71 implied volatility for the February 14th at the money, or the 100% moneyness. I went and looked at the same thing for IBIT, as you said, which is the BlackRock sort of Bitcoin proxy. And MicroStrategies is about 1.6 times the implied volatility of IBIT. And so it's leveraged. Okay. So I think the ratio there sort of makes sense, maybe. It struck out to me because it for a bit, it had a higher implied volatility, meaning the options were priced more. They were pricing in more of an expected move. So that's okay. Lower end of the range.
Yeah. So what are some strategies? And I'm not saying what we should do here particularly, but generally when you want to get
don't do this.
No. Well, you want to get long volatility, any kind of strategy. What are the types of
the straddle is the easiest one. Buy the call, buy the put.
Sure. What about calendars?
Yeah. So I would buy the Yeah, no, I could do a calendar. I could do that.
Yeah.
Sure.
Yeah. Okay. Yeah. I mean, it's stuff like that, right? Where you're, um, there's definitely option plays. And you could, by the way, you could search. There's plenty of resources here when you have theories like this. So this is interesting. The break even on that straddle for the 2 week straddle is like what, 13 and $11. So 20, let's call it $25, $26 move.
Yeah.
So, you know, um, that's interesting. And then you could even sell away, what that means from a, distance, because $26 is what, about 8%? I'm doing math here. I didn't do it in my head. So let's see, 50, 8.2%. So yeah, and you could sell that away and, wow, God, that's cheap. All right.
Don't do it though. This is a
It's just interesting to see a stock that has had so much movement. I'm trying to, what would we use to determine if this was a coiling spring, right? I mean, if you look at I think the data point you and I would say is, its volatility is settling in, right? So it continues to drop, but if it stays stable for a little while at this lower rate, knowing, what's going on with, with MicroStrategy just having that ability to move quickly, it might be something to watch for, right? So maybe it's a little early, but
I mean, the stock's been in a range too. I mean, after the really big run up towards, the end of November, it's been, you could make the argument it's been a little bit of a sideways channel. So just for everyone playing the home game, don't do those trades. This is kind of theoretical, but the risk on that is if you were to buy that, number one is that's a very short-term trade. February 14th is like a week away. If you don't get a move more than 8%, you will lose money on that trade.
Even if
you do get a move,
you get 7.5. You're like, it's moving, and if it doesn't finish outside of that range, you will. That's true. You lose money.
Yeah, or if volatility drops more, you could lose money, and the stock goes nowhere. So, that is a play that you think, okay, I want to get long volatility. I'm not sure which way it's going to go. So, all right, Jay, any recommendations this week?
What do you think about daily options on MicroStrategy? No, should I not go there? Okay, never mind. Right.
No, we've already given enough, too much information to the audience to don't do any of this stuff.
I know.
Lock and hedge.
Yeah, this is just taking a look and interpreting what's going on in the options market, right? Which is what we apply towards.
All right, so I'm glad you went where I was thinking. You went a different direction, but I just said, I looked at it and I said, that's low.
It is absolutely low. You're totally right. It's absolutely low.
And it can go lower. Who knows? Maybe it's 50 vol next week.
Okay, right. That would be interesting. That would be.
Don't short the straddle either.
That would be unexpected if that happened. Oh my gosh! Right.
We had a friend of the show. I think he listens. Our friend Gary. He had sent us a note, and I think it was the day when the market gapped down 2%. I think towards the end of the day, he shot me a note, and I think you were on there. Said, if you would have told me Bitcoin would be up 3% today, I would have, no way. And that was a crazy day. But all right, recommendations, Jay.
Started watching a new show called Paradise.
Okay, I'm interested. Tell me more. I think
it's on Hulu.
Okay.
You know what? There's like the very first episode, you get this kind of surprise twist. So I don't want to even go into it too much, but it's about a Secret Service agent who's protecting an ex-president at this point, and there's some tension between them. I don't want to explain why, it's something has happened that has caused them to live in a unique scenario, and I'm just starting. I would say the first episode has me gripped. Paradise.
The way you're explaining to me is like you think your phone is tapped and you can't say anything. This is really good information, Jay.
I can't say a darn thing about it that would make it interesting, because the thing that is so interesting about it is like the first episode, like, wow, and I don't want to ruin it for anybody.
All right, so Paradise, good, because I've been looking for something to watch. I mentioned last week I finished Agency. and I came around on it, Jay. It's a recommendation.
Yeah. Okay. Have you watched the new Dexter?
No. Well, the new one where he's young, or the new one
young.
where he's
the one where he's young, where it says it says like college. Okay, so I watched the first couple, and like you can't watch too many of those back to back because it's a little creepy. So they're doing a good job. Like creepy, like that's the emotion they're trying to elicit from you. So I know you like Dexter. I know you didn't like nobody liked the way the first series ended. I didn't mind the follow-up where they found him later in the woods and up north, but this one seems interesting where he is younger. His father is played by Christian Slater. In my mind, Christian Slater can do no wrong. I love every role he's ever played. I wish he had more. So, I think it's not bad. So far I'm 3 episodes into that.
Do you know they're bringing back the in June, Dexter Resurrection? Apparently he didn't. Well, I don't want to give too much away, but
I mean, the first episode of this series, they show like rushing him to the hospital after he got shot by his son. So,
okay,
yeah,
okay. We just ruined it for everybody.
No, it's not. It's completely irrelevant to the new show, to the show I'm talking about.
I know, but I'm telling you, there's going to be Dexter Resurrection. I mean,
people, it must have just scored so well in some tests where they're like, we need more Dexter.
Yeah. All right, that's it, Jay. Thanks for coming back on. I know the audience was waiting. I think we solved the problems of the world, and that's it. And we want Barkley to run for 400 yards, but the Eagles to lose. Is that
yes? So it's already over by now. By the time people are listening to this, but that is our that's what we're hoping for. Set all records, Barkley, but you can't win. Sorry, buddy. You're on.
As New York Giant fans, that's what we're rooting for.
Yeah.
All right, Jay. Thanks again. See you, everyone.
Thanks, Eric.